so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, currently the mortgage market is getting absolutely wrecked, you guys. Not only have refinance applications completely disappeared, home buyers are now dropping out at an alarming rate due to unaffordability. To purchase right now is essentially a triple whammy of expenses. Not only do people have to live in an environment with runaway inflation, they're also in an environment with skyrocketing interest rates, and even worse, with home values that are very overpriced and, in my opinion, at the very peak of this housing market bubble. Now, even if some of those buyers still want to purchase now that interest rates have skyrocketed, many potential home buyers aren't even able to purchase anymore because the increased interest rates shot up their mortgage, which in turn affects their debt to income ratio. Debt to income ratio has to do with loan qualifications. So now that we're in this environment of skyrocketing interest rates and essentially a rug pull, mass exodus of buyers now quitting the market, right? So today what we're going to talk about is how the skyrocketing interest rates are negatively affecting the mortgage industry as it pertains to debt to income ratio and rate locks, because these rate locks are essentially creating toxic competition in the mortgage market. So I want to touch on that, guys. Now remember this, okay? I'm not a financial advisor. I'm a YouTuber sharing with you my thoughts, almost like a diary, even though my main jobs are a loan officer in Texas, realtor in Houston, and an instructor provider of education in the Houston area. And if you guys can, please, for the YouTube algorithm, like this video, subscribe to my channel if you haven't already, and as always, comment below. You have no idea how much I appreciate very good comments, essentially giving us intel on your local market or just giving me your beliefs on whether or not you even think we're in a housing market bubble and whether or not we're headed into a crash. And one thing I learned from yesterday, I went on YouTube yesterday and I listened to a live chat with Michael and Jeb. They're essentially realtors on YouTube. And what I've learned is there is a huge, massive difference in the definition of what a housing market crash is, right? To me, if a house goes down even just 15%, let alone 20%, that's a housing market crash, because think about all of the recent owners, right? If you recently purchased a home, you don't want your home to go down 20%. To me, that's an absolute crash, but that's a video for another time, okay? Let's get started on this right now. But before I do, I need to explain to you guys exactly how expensive it is for a lender just to pre-qualify a potential homeowner. What you have to remember is because of the Dodd-Frank Wall Street Reform Act, lenders are now required to employ loan officers. So loan officers are essentially required to have a W-2 salary. And when you have a W-2 salary, you have to give essentially benefits, medical, you have to pay taxes as an employer and things of that nature. So it's a lot more expensive for these lenders just to have loan officers work for them. But the process of pre-qualification takes a lot of time for a good loan officer to review documents. But not only is that time, is it time consuming, which time is obviously expensive, it costs money to run credit, and it costs additional money to run files or potential homeowners through underwriting, right? And that's called automated underwriting system, and I'll refer to that in this video as AUS. So a lot of loan officers that are really good loan officers are running their clients through AUS. So in other words, you guys, it's super expensive just to stay in business as a lender. So not only are we having the 72% decline in refinance apps, 8% decline in purchasing apps, now we have a surge of borrowers falling out, not to mention the unhealthy competition these skyrocketing interest rates have created. And essentially what that's going to do, guys, is my worry is it's going to force the mortgage lenders to start laying off people that are not pulling their weight. The thing is with that situation, you guys, I don't necessarily mind that, because I believe there's too many realtors, there's too many loan officers that are not really skilled and not really qualified to help people with the largest transaction of your life. So the way that I see it, the strong will survive, and it's going to be easier for you guys to find a professional in the mortgage market or even the realtor market that has your best interest in mind, but also has the skills to get you to the finish line. Now let's start at debt to income ratio. So let me define debt to income ratio for you. Essentially what it measures is someone's ability to repay the loan. So your debt divided by your income, you have a ratio. Now typically you can go a higher debt to income ratio when it comes to FHA. Conventional is generally tighter when it comes to debt to income ratio. But what's happening right now is most sellers aren't even entertaining offers from FHA, which is forcing a lot of people that probably should get FHA to get conventional mortgages, because generally what I'm saying, and again, this is my opinion, most sellers want to see the conventional mortgage. But here's the real problem, you guys. And again, I've been a loan officer for 20 years, and these are just my opinions, but what I generally notice is these buyers want the maximum debt to income ratio so they can get the maximum purchasing power. So when any adjustment happens as far as expenses, that file needs to be re-underwrote, okay? And when things are re-underwrote, especially if it's at the last minute, that's when last minute problems can happen. So put it in perspective, right? So if you're qualified today and you're quoted and underwriting is ran at a 5.5 interest rate, say it takes you 1 month to purchase a house, and in that 1 month period, the rates go up another 1%. That can bring your payment up $200, $300, $400, and you may no longer qualify for a home loan. Now that's especially risky when home buyers are putting in offers for new home builds that are not yet complete, because often if someone puts an offer on a new build and it's just dirt, it could take 6 to 9 months to complete that project. Now, put it in perspective. If someone went under contract on a new build last year in November and got underwritten and qualified based on a 2.5% interest rate, and now fast forward to today, they have now a 5.5 interest rate, their payment may have gone up $600, $700. If your lender and loan officer is not re-underwriting your file to make sure you're qualified, you may find this out at the very end of the transaction and be in serious trouble. But you guys, in turn, what that's doing is it's forcing a lot of potential buyers to drop out of the market, not because they want to, but because they no longer qualify. So even with these drops in applications, the applications that we do get, a lot of the buyers that are pre-qualified are soon to no longer qualify. So when the interest rate skyrocketed, a lot of these loan officers had pipelines full of people that are pre-qualified out there looking at homes, right? And to pre-qualify them, remember, that's a very expensive process. So the interest rate skyrocketing like that, it hit a lot of loan officers' pipeline. It shed a lot of those home buyers that were either first-time home buyers or home buyers that were barely able to qualify anyway. So it is hitting the lenders in way more ways than one. Not only the lowering applications and things of that nature, to take someone all the way to pre-qualification stage, to get them out there in the market, only to have interest rates go up, they no longer qualify. It really hurts a lot of people. So that alone is destroying the profit margin from these lenders. And that's not good for us. We want lenders to be healthy, because when they're healthy and when they're getting cash flow, a lot of them can have much lower interest rates per se and get you guys a better deal. But right now it is so crazy when it comes to debt to income ratio, because we don't know next month. Rates may be a 6.5%. So that means everyone that was pre-qualified last month needs to be pre-qualified again. Do you understand, right? So anything that changes income, debt, money that you have saved, you need your loan officer to re-underwrite you through automated underwriting system, right? AUS, to make sure you still qualify for that house. That also protects you, but it also protects the lender. It's a win-win situation. So in other words, stay in contact with your lender, make sure they're reviewing DTI, because I am personally seeing a surge in people dropping out, either quitting, but a lot of them just can no longer qualify for a loan. Now, one of the things I would recommend to anyone that's out there purchasing right now is stay in constant contact with your loan officer. In every house that you're interested in purchasing, make sure your loan officer gives you custom payments and a custom idea of how much it's going to cost you out of pocket, which in my mind, other than the sales price, are the two most important things. So how much money is it going to cost out of your pocket for the next 30 years, right? And how much money will it cost for you to move in the house? You need to be talking to your loan officers about every house that you're interested in, and you need to get those numbers. And if the numbers are higher than they were originally, you need to make sure that your lender or loan officer is rerunning you through underwriting. Now let me go over rate locks. So what I'm noticing right now is because of all of the skyrocketing interest rates, some people are locking rates, some people aren't locking rates. Generally, the lock period for interest rates are 30, 60, and 90 days. Now, if a lender has to bust the lock or someone doesn't qualify or someone drops out, a lot of times lenders get additional fees or penalties in the secondary market. So the fact that people are dropping out, people are quitting, if those people have a locked rate and they don't close, the lenders suffer even more for that reason. And let me tell you what the skyrocketing interest rates are doing to locks. So say I help someone with a loan, they find a house, I disclose all the paperwork, and then I lock in their interest rate. I send them into underwriting. We order the appraisal. They're in processing. They're in setup. Now, a lot of times what happens is during the process when we're working hard, another lender will come into play after they're under contract and offer them a lower interest rate. A lot of people, because of how the pandemonium is with interest rates right now, will actually cancel their loan with the person they've been working for and go to another institution at a slightly lower interest rate. And here's the problem with that. A lot of these loan officers are only as good as their honesty. I have seen so many people being bait and switched, or so many loan officers that don't have the ability to properly disclose what's called an LE, which is a loan estimate which took place, the GFE or good faith estimate. Now your LE is supposed to have all of the fees that you will experience during the process. It's supposed to have how much money you're going to be paying out of your pocket. So a lot of loan officers, they don't even know how to set up an LE accurately, but nevertheless, it's creating a very toxic competitive market once again, whereas before pretty much everyone had similar interest rates. It wasn't really a toxic competition. It was kind of like whoever works the hardest gets the business. Now it's not necessarily like that. It's kind of, it's just, my point is, guys, it's very scary and you're gonna have to watch your paperwork. But what this is doing in turn is it's absolutely wrecking these mortgage companies, you guys. I can't express that enough. We're gonna probably start seeing a lot of the fat being trimmed off from realty shops or firms and also lending institutions, because in order for you, moving forward in this year, in order for you to stay in the mortgage industry or real estate market, you're probably going to need to be really good at your job, right? And actually, that's what we want. Unfortunately, a lot of people are going to be hurt as a result of the massive loss in profit in 2022 that the lenders are currently taking. Now, I'm going to conclude this video, guys, with just some general conclusions I have from making this video, and that's this. If you ever meet a loan officer that you love, that you feel is working really hard for you, that's honest, treat them well, right? Treat them well. Good loan officers, good realtors are hard to find. So if you find one, stay with them, hold on to them, and stay in constant communication with them. You don't even know if they're going to be, they're going to have a job in 2 weeks. So just stay in constant communication with them. Thank them for doing all of the work that they do when they're giving you payments, when they're giving you out-of-pocket expenses, because all of that takes a ton of time and costs a ton of money. But when you find the right one, hold them for a very long time, because again, it's hard to find good people. Now, you guys, that's going to conclude this video. Remember the formula, right? First comes interest rates, then sales, then price, then inventory. So we're starting to see the interest rate surge do its work as far as cooling down the housing market and combating inflation. Unfortunately, there is repercussions of that, because in my opinion, the Federal Reserve should have done and taken these measures much sooner, so we wouldn't have to go through this whiplash of a situation. And a lot of people are going to be hurt, not just lenders, not just realtors, not just all of the professionals, but all of the homeowners that recently purchased are the biggest at threat of being upside down in their house, not being able to sell, going into foreclosure. And I really hope that doesn't happen. Now, I'm preparing for a crash because I want to invest in real estate and make a ton of money, But right now I'm sitting back, I'm waiting, I'm building my credit, I'm loving my family, I'm stacking my down payment, and I'm completely out of consumer debt. And I've rebudgeted like 2 times already. So I'm just preparing you guys. And I would recommend you guys may want to do the same exact thing. Now, thank you for tuning in once again. Now, if you're out there investing in real estate, I do wish you luck and I hope you win.